This is a discussion on capital market and securities market. And I have prepared a small PPT covering the entire features of the capital market into various modules. The main modules are presented in the PPT, and I will run through all the modules in a way that the basic, the features of the capital market can be understood, and the various, parameters, the legal compliances, the various elements which function and perform in the capital market can also be understood, and the interrelationships between the various functionaries and the various elemental points of capital market can also be understood uh, from the various modules which I will be discussing. The first module relates to primary market. This primary market has got elements like features, operating modalities, and regulatory framework. The second module will consist of secondary market, which will continue consist of the basic features, operating modalities, and regulatory framework. Module 3 will consist of financial market instruments and investments, because this capital market must be for certain things. So what are those things? These are various types of financial market instruments and their essential features. Then comes your portfolio managers who will be managing the capital market, who are the soldiers actually who play in the capital market. So their role in capital market and the regulatory framework. Then comes the role of stock exchanges in capital market and the role of Civi in capital market. Both these two modules have been clubbed into one module because stock exchanges function under the administrative domain of Civi. Then the mutual funds, which are also one of the main parameters or the main elemental function of capital market. Then we have got merchant banking and merchant banking. Then we have got venture capital and capital markets. And then we have got investors awareness and protection, because investors are the prime features of a capital market scenario. And so naturally, this investors awareness and the protection lies, at the core of the capital market functioning. So one of the module has been devoted to this. Then we have got depository system, because everything is in now digital form. So depository system has come. And then we have got corporate governance in capital market and securities market, because everything has to be as per the prevailing legal under the legal framework, as well as the assurance of the capital market institutions. The total capital market institutions, the capital market environment has to assure the investors and the various functionaries that everything is transparent and everything is healthy and it can be confidently relied upon. So these are the basic modules which I have prepared to take, to take the journey into the capital market. And let us start this thing now. Only thing has to be ensured that this capital market is a very, very dynamic market. It contains many, elements, tenets, and functionaries, and it is really dynamic. And naturally, managing a capital market and ensuring complete compliance and complete effectiveness is very, very difficult unless the money market and the financial market of an economy is geared to these things. Because general economy has got three types of markets: money market, financial market, and capital market, and the securities market. All these things are interlinked in such a way that the whole thing in a wholesome way functions to create a healthy economy. So naturally, if the money market is not working properly, it will impact your capital market as well as the other, the financial market as well. Similarly, if certain things in the broader spectrum of financial market is not working properly, this will severely impact the capital market as well. So Indian economy, in the context of Indian economy, since we are all discussing in the framework, within the framework of the Indian economy, just to be ensured that we assume that everything functions as per the legal framework established by the Ministry of Finance and Ministry of Corporate Affairs, and these things fall in the right places. So now coming to primary market. So in the primary market, we will briefly discuss these things. Basically, what is primary market? And as I have already shown in my PPT, the financial market fundamentally consists of two types of market: primary market and secondary market. Now again, both these markets can be either organized or unorganized. And now organized market consists of over-the-counter market and exchange traded market that we will come later on. But our main discussion will be based on that as if the markets are organized, because you know dealing in an unorganized market is very, very difficult, and lots of problems, constraints become, which is beyond comprehension of a lecture within these 2 hours. So I will confine myself as if it is a primary market and secondary market, and these markets are organized markets. Then comes, what is primary market? Primary market refers to markets where resources are mobilized by companies through issue of new securities. This issue may consist of equity shares, debentures, bonds, or other hybrid securities on first issue basis or as right issue to the existing shareholders. This is basically, when this company go for IPOs, this initial public offer and all these things, the primary markets are generally. And now basically, the resources or funds raised by issue in the primary market are required for new projects, for new companies which are coming. So they go by this IPO, this initial public offers. So they use this primary market route, and these funds are generally required for new projects or for existing projects going for any expansion, diversification, modernization. So this is the basic concept of primary market: initial public issue, or some rights issue, bonus issue, and all these things. And the funds are raised for expansion, modernization, and new projects and all these things. Now, the primary, now we have been discussing this intermediaries. So we have already touched upon these intermediaries. Who are the persons who deals, or rather who functions in these markets? So here you see the primary market intermediaries. These are merchant bankers, lead managers who manages those public issues, registrars and transfer agents, then underwriters, then bankers to the issue, portfolio managers, advisors to issue, debentures trustees. This we will discuss a little, later in much more detail. But these are the basic intermediaries who are the basic functionaries who function in a primary market. Then operating modalities. Now, what happens in primary? So we have seen what is primary market. We have seen the functionaries or the people who actually functions in a primary market. Now, what are the modalities in a in a primary market? So these are initial public offer, further issue of capital, that is rights issue and all these things. These rights issue to existing shareholders. Then issue of securities under reservation. This can be to the foreign collaborators, mutual funds, merchant bankers, auto banks and financial institutions, NRIs, employees. Then offer to public, then bonus issue, and qualified institutional placement. So these are the modalities when we go for a issue of shares, and the destinations are these. So we go to the primary market. Now, Civi has formulated various rules, regulations in respect of the above modalities, and most of them can be read with this Companies Act also, to monitor the activities of the primary market so as to build a disciplined and healthy capital market. So basically, so far we have seen the capital, this primary market. Uh, what is a primary market? Who are the functionaries? And the modalities of entering into this primary market. So this is there is various rules under the SEBI. So for example, the SEBI Merchant Banker Rules 1992 and SEBI Merchant Bankers Regulation 1992. I'm not elaborating on the rules, but I'm just telling on the rules. SEBI Registered to an Issue and Share Transfer Agents Rules 1993 and SEBI Registered to an Issue and Share Transfer Agents Regulation 1993. Then SEBI Underwriter Rules 1993 and SEBI Underwriters Regulation 1993. Then we have SEBI Bankers to and Issue Rules 1994 and SEBI Bankers to and Issue Regulation 1994. Then we have got SEBI Debenture Trustee Rules 1993 and SEBI Debenture Trustees Regulations 1993, because sometimes companies issue debentures which are quoted publicly. So naturally, we need to appoint debentures trustees when the quantum of issue, crosses certain threshold. Then there are certain deficiencies which we have observed in primary market, because sometimes people ask me, sir, we are dealing with capital markets, but there are certain deficiencies, how we can rectify these things. So now it depends how the laws, are framed, how the Ministry of Corporate Affairs and SEBI take stringent measures to control and to rectify things. But these are the deficiencies which I observed. Unreasonable pricing of securities and price rigging, incorrect and misleading disclosures in offered documents. This calls for corporate governance. That's why I kept a separate module for this. Misleading prospectus this is also a corporate governance issue. Too many publications at the same time. Then incidents of grey market, incorrect market information, unreliable investors and promoters, lack of transparency and fair play in the capital market amongst the various intermediaries. So these are the basic, deficiencies which the investors, faces while entering the, dealing with the primary market. Then there is a concept of prospectus, which I'm not going to, explain in detail. It is explained under the Companies Act. It means any document described or issued as a prospectus and includes a red herring prospectus referred to in Section 32 of the Act. And generally, this prospectus, contains details of an issue of shares or debentures which are going to the public, so that the public or the investors can be aware of the various informations they are, they're supposed to get, based on which they will decide whether it is worthwhile investing in the company or not. Then, in order to rectify certain things which I was discussing, this CB has come out with certain initiatives, because those deficiencies were observed over a long period of time. It is not possible to rectify 100%, but at least we can come close to 85 to 90%, and we can leave 10% to the moral obligations of the, various functionaries in the capital market, so that they can, on their own, by exercising their rightful conscience, can do something, because everything cannot be mandated by law. So these are the certain things which the SEBI has introduced. Establishment of more mutual funds to make to make the spread over more, wide. Expansion of private sector banking, buyback of securities, delisting of securities from stock exchanges, issue of securities in electronic form, that is this digital, this depository systems and all these things. Book building and market making concepts. Due diligence responsibility fixed on merchant bankers is very, very important, also a part of corporate governance. SEBI guidelines for disclosure of various information by the intermediaries for investors' awareness and protection of stakeholders. And then this dematerialization of securities, and then compulsory credit rating of securities and investment schemes, so that the investors understands that I am investing in certain certain instruments which carry a healthy credit rating, so my money will remain safe over a reasonable period of time. So these are the, initiatives which CB has taken to protect the investors and to ensure some kind of compatibility and confidential element building in the primary market. Then comes the secondary market. What is secondary market? Secondary securities market consists of two segments: primary market and secondary market. We have seen, and primary market is the place where companies create and issue securities for subscription by public, while secondary market enables holders of securities to trade them. Fundamentally, secondary market deals in securities previously issued. That is the crux. Secondary market essentially consist of comprise of stock exchange which provide platform for purchase and sale of securities by investors. Initially, it is done in the primary market. Now, in the secondary market, the investors trade on these things. They buy and sell the securities. So in India, apart from the regional stock exchange, there are exchanges. Basically, these are the two main: this National Stock Exchange and Over-the-Counter Exchange of India, who provide nationwide trading facilities with terminals all over the country. Then comes your this brief this thing on capital market by NSE and all these things. We have got a screen-based trading. Then we have got dip segments. So we have got two segments in trading. Uh, One is your the screen-based trading. That is basically screen-based trading for equity and preference shares, and another is your wholesale debt market segment. So these are, I mean, areas where this debentures and this debt marketing, I mean, these elements are traded. And further trading system in the secondary market provides two subtypes, namely continuous market and negotiated market. This is very important. In continuous market, the buyer and the seller do not know each other and they put their best buy and sell orders which are stored in order, book with price, time priority. In a negotiated market, the traders are normally decided by the seller and the buyer who knew each other and reports to the exchange through a broker. The deals negotiated or structured outside the exchange are disclosed to the market through NEAT and WDM system. So this is basically how this trading takes place when we actually hit upon the secondary market. Now, this is also important. As we have seen, there are certain intermediaries in the primary market. There are certain intermediaries in the secondary market too. These are basically stockbrokers and sub-brokers, and they are governed by the SEBI Stockbrokers and Sub-Brokers Rules 1992 and SEBI Stockbrokers and Sub-Brokers Regulations 1992. Similarly, we have got this portfolio thing. SEBI Portfolio Managers Rules 1993 and SEBI Portfolio Managers Regulation 1993, because portfolio managers, they are also an important part of this capital market and this primary market and this secondary market, because they lead, guides the investors, and they have got a very, very crucial function to play in the capital market. So SEBI has got certain regulations and rules for them so that they adhere to these things and they discharge their functions in a way that is healthy, efficient, transparent, and also confident to the entire, fraternity of the investors. So now comes this thing. Now we come to the financial market instruments. So we have seen primary market, we have seen secondary market. Now we are coming to financial market instruments. So this market has been created, but what this market does. So now we will be coming to the instruments which are bought and sold, dealt in the financial market. So these are the things. The instruments available in the financial markets for investments are guided by investors' preference, the regulatory framework, and financial market dynamics at a given point of time. So, as in a normal economic market, we see that there are certain products or certain items are available. These items generally, if you from a common sense standpoint, you will find this what the buyers needs. So the markets are abundant with products which buyer actually needs. Similarly, so investors preference will guide what type of products or what type of instruments the market will throw. Similarly, the regulatory framework, the moment there are products available in the market, whether it is financial product or any consumer product, there are certain regulations, regulatory framework, so that the discipline is ensured. We need to have some kind of discipline. So this regulatory framework. And then this financial market dynamics at a given point of time, based on the investor preference, based on the regulatory framework, based on the functionaries, based on the documentation that has to be created and maintained, the dynamic comes, because ultimately in this capital market, which is basically an investment market, whether it is primary or secondary, the people or the investors looks into the return. I'm investing 5 rupee today. How much I'm going to get back, say after say couple of months or a couple of years. There is a investment horizon, this time frame. So this financial market dynamics is geared and is focused towards how much return I should be able to give to the investors who is investing in this investors market or in this financial market. So this financial market dynamics is basically seeing the future, whether otherwise this financial market will collapse if everybody or every product is is incurring losses. So after a couple of years or after some time, you will find no investments are coming, so the capital market will collapse. So in order to make the capital market active and it should be functioning in a healthy way, the dynamics of return on the investment, that is ROI, has to be has to be ensured. So financial market dynamics is basically focused on how much return I'm giving to the investors over a given time horizon. This is basically this thing which I have not explained in my this PPT, but this is I'm explain to to the listeners who will be listening afterwards. So investor preference vary with attitude, risk, investment objective, goals, investment horizon, and the tax impact for a given investment scheme. So based on which the market comes with varied types of products in a particular at a particular point of time. So then we're slowly going to this financial market dynamics also plays a significant role towards the withdrawal or emergence of financial products, instruments in the investment horizon in the securities market. This dynamics is a resultant effect of a country's money market and capital market, which I explained, just mentioned a little earlier. Objective at a given point of time, guided by the overall macro and the microeconomic policy of the nation. And this paragraph will this say the regulatory framework or laws governing the capital and securities market prevailing at a given point of time also determines the availability and popularity of certain investment schemes. We have seen certain investment schemes or financial products which are attractive for investment at a given point of time have gradually been withdrawn as they lost their attractiveness from the standpoint of investment due to certain changes in the regulatory laws that impacted adversely these schemes and products. So ultimately, again, this capital market or this financial market is guided by whether it is primary or secondary, these basic things. Three things: investors' preference, the regulatory framework, and the financial market dynamics at a given point of time. So now we skip, we have discussed these things. Now we proceed to this broad classification of financial instrument. This is very important, and one should know. These are, pure instruments. These are equity shares, preference shares, and debentures bonds, which are issued with the basic characteristics intact without mixing features of other class of instruments. That means shares are shares, debentures are debentures, bonds are bonds. Then comes hybrid instruments. These financial instruments are created by combining the features of two or more instruments. For example, convertible preference shares, cumulative convertible preference shares, non-convertible debentures with equity warrants, partly convertible debentures, optionally convertible debentures, secured premium notes with warrants, etc. So these have got dual features. Some kind. They are not very simple. Their features are not very simplistic. They've got slightly complex features, but still investors like them, and so they are in the market. Derivatives, this is very important. Futures and options belong to this category. Belong to the category of derivatives. Derivatives are contracts which derive their values from the value of one or more other assets known as underlying assets. So your capital market basically deals with three kinds of this thing: pure instruments, hybrid instruments, and derivative instruments. This one should know. And then comes this the whole host of products available. So this is I just let us have a run through of the host of products which is available in the capital market, irrespective of whether it is primary or secondary. Equity shares, preference shares. Preference shares have got so many classifications. I'm not repeating it once again. Debentures, again, debentures have got numerous classifications. Equity shares with detachable warrants, deep discount bond, sweat equity shares, stock investment schemes, dual convertible bonds. Dual convertible bonds. Then we have got debt instruments with debt warrant, commodity bonds, mortgage-backed securities, global depository receipts, foreign currency convertible bonds, derivatives. We have got this some conception futures. What are futures? These are interest rate futures, treasury bill bond futures, stock index futures, currency futures. Sometimes we call it as options are there. So call option and put option. So let us see what are call option and put option. In call option, an investor has a right to buy. An investor takes a call option if he expects that the market price will be higher than the strike price to earn the difference as his profit. In put option, an investor has a right to sell. An investor takes a put option if he expects that the market price will be lower than the strike price. The lower the market price than the strike price, the higher will be the profit for the investor. An investor can simultaneously buy call as well as put option if is uncertain about the market condition. An option can be exercised by two ways: on the expiry date or any time before the expiry date. So these are basically when one deals in the products and actually is acting with certain instruments in the capital market. He is dealing in these things. So these ideas, these conceptions, should be kept in mind. Options are openly traded and ensure transparency. Options limit risk exposure for a stipulated time and enable an investor to manage investment risk under volatile market conditions. Again, this can be two types: forward and swaps. Then other things are treasury bills. These are also, certain products in that financial market. Commercial bills, certificate of deposits, commercial paper. Then there is one we often come across in a gilt-edged government securities. These are basically government securities market. What are these? These securities are issued by central and state governments, semi-government, city corporations, municipalities, port trusts, state electricity board, housing boards, large financial institutions. These securities are held by RBI and eligible to be reckoned for the purpose of SLR of the banks. Since these are issued by government, they are considered to be very secured. The secured financial instruments which guarantee both safety and growth. Their rate of interest are marginally lower and is generally payable half yearly. Their interest rates are lower because they offer you additional security, that confidence is there. So naturally, when they are offering some kind of additional benefit which is considered as security, some kind of leniency has to be given to them with regard to the interest rate. So that's why their interest rate is marginally lower. Then we have got foreign direct investment and foreign institutional investment. What is foreign direct investment? These are investments made by a company or individual in one country in business interest in another country. The key features of FDIs is that it is an investment that establishes either effective control and a substantial influence over the decision making of a foreign business where the investments by way of ownership or controlling interest has been made. Then what is foreign institutional investment? So these are actually, established or incorporated outside India, which invests or proposes to make investments in the securities market in India. These are also entities, and this is as per the Civi regulations, 1993, and here also this capital market reform. Now, this I don't want to, discuss from this PPT, but I'm giving you. Previously, it was this this Capital Issues Control Act, which was, long back in the 90s. This Capital Issues Control Act. This was repealed, and then this, the economy got liberated, and all these things. SEBI came into being, and a lot of power has been entrusted to SEBI, and this market is almost free. That's why now, this here I would like to slightly, come out from my PPT and want to explain certain things, because now if you look into the history of this capital market, it was basically regulations, and this rules and regulations was basically towards controlling your each and every step of dealing in a capital market, this Capital Issues Control Act and everything. But the moment this investment norms got liberalized and Capital Issues Control Act was repealed, definitely a lot of new regulations and controls have come through stock exchanges, LODR, and this SEBI. But if you very carefully look into these things, these are basically, I mean, disciplining the investors, disciplining the market, and trying to ensure that move an efficiency and efficacy into the market so that the entire capital market grows in a very healthy fashion, and it competes with the overall this world. It is a global focus so that it becomes globally efficient, and it becomes the foreign investors find it comfortable. They get the right confidence, and the various companies and all these things, they can go for cross border investments and all these things. So the basic thirst of this entire the CB regulations and the associated or the ancillaries, the incidental laws which governs capital market are basically towards ensuring discipline, ensuring confidence, ensuring your some kind of reliability, and making you more and more educated how to deal in a capital market. It is not only for the investors but also for the entire fraternity of the functionaries and the various people, organizations, entities who comprises the entire financial and the capital market. But the previously, these rules and laws were there, but these were a bit punitive and as if it was restricting your movement. Here, we're allowing you to move. We are opening up a lot of new paths. I am giving you extreme freedom, but at the same time, I am disciplining you and making you aware and trying to help you self to govern yourself in a way that so that you understand the what is the best way I can perform in a capital market with a given amount of investment in order that I should get a prescribed rate of return, whereas the portfolio managers and the entire functionaries will help you achieve that. So it is some kind of governing. The laws are basically governing. Previously, the laws were a bit punitive. It was a punitive and controlling. It is basically governing and helping. So this is the basic, difference which was in the previous, regime, and which is now prevailing now. So this is one here also one thing. This compulsory credit rating is also one of the things which have come, because this says that unless the products or the items which have been issued is properly credit rated, the investors may not get the confidence. This is only to help the mm, uh, investors to know exactly they're investing in a products which are reliable. So this is okay, and this introduction of depository system, because this paperwork has to be reduced. So this is one. And let me see if I have missed out anything from this module. This credit Civi and all these things, and calculations. No, everything is okay. I mean, yes. And another thing, this present this thing is to encourage this NRIs and this foreign investors to come, because previous laws and other things, capital markets and all this capitalist controller, they were a bit unfriendly to this global market, global capital market developments. So we have synchronized ourselves with the modern capital market from the global perspective, and we find that now the foreign investors also find it quite comfortable. So it's basically encouraging investments both in the in the Indian market as well as from the global market. Now, role of SEBI in the capital market and SEBI market. This is which I have already discussed a bit, but let's see. This module says a little more. I mean, in a more pinpointed way. What is the basic this thing role is protecting the interest of investors in securities and create investors awareness, which I was just telling. Then promoting the development of the securities market and regulating and reforming the securities market with the changing dynamics of business environment. It is, these three essential criteria of this. The role of SEBI speaks everything. It protects investors' awareness. It protects investors with regard to its awareness. so that it is creating investors awareness, promoting the development of the securities market so it is growing, and regulating and reforming securities market with the changing dynamics of this environment. So if we can score 100 out of 100, I mean, in a capital market, considering these three parameters, we can be at par with the best global practices anywhere with regard to the capital market functioning. So now SEBI's regulatory jurisdiction extends over corporate in respect of issuance of capital, transfer of securities, and their dealing in the securities market. SEBI's jurisdiction also extends to all intermediaries, entities associated with the securities market. That means everything within under the capital market is under the umbrella of SEBI. So now this I am not repeating because SEBI is empowered to do so many things, and this is if somebody goes through this PPT, we'll be able to do. But in nutshell, those 3 points include everything. And this another, one particular point has come to my mind. This is to prohibit fraudulent and unfair trade practices related to securities market, including insider trading. I have got a PPT on this literature on insider trading that I will discuss. But this is something very, very important, this insider trading, that I will separately discuss in another module. And this is, I have covered everything. So there is nothing, else to be discussed under this. So SEBI has got host of rules and regulations which determine that how it focuses and hits individual functions so that they adhere to such things. So there is one this buyback of securities, and this can be from open market and from existing shareholders through trade offer. This is very important. These above rules, what are the rules I have listed? Because these are the whole, so there may be 50 rules like this. So it is not possible to read each and every rules, but the crux of these rules are in this 2 hours lecture. The above rules comprehensively enable SEBI to regulate the entire securities market and monitor and control the activities of the various intermediaries who are adjunct to the multiple functions and operations of the country's securities market with a view to ensure discipline, good conduct and governance, and efficiency in the capital and the securities market. So this is the crux of the thing which all those rules which is stated slightly ahead of this module, in another page, comprises. So these are basically, here I cannot do anything. It is basically the laws and the regulations which are given in the various chapters, and it has to be followed. Now, this is very important. For this, certain procedural requirements with regard to these aforesaid regulations have been stated in 10 schedules, inter alia comprising such matters. These are when a company or a legal entity goes for these public issues or for dealing in these shares, and their products are already floated in the capital market. So these are the points which has to be ensured by the individual corporations and the organizations. So terms of securities, whenever we're going for an issue, so this terms of securities issue has to be very, very candidly mentioned in a statement called this prospectus. Then corporate governance, that is all pervading, all pervasive, and has to be ensured from right from the beginning till end. That corporate governance has to be there. Then comes a disclosure of all relevant information having material bearing on the operation and performance. Disclosure of all relevant information having material bearing on the operation or performance. And then price sensitive information, which is a part of insider trading, which I will discuss later on. Disclosure of financial results. Now for listed companies, every quarter we have to issue these unaudited financial results, limited review results, so that investors can see how, in which direction the company is going, and whether their investments are in safe hands. Then transfer of securities, etc. So all these things, I mean, these are the broad classifications: terms of security issue, corporate governance, its disclosure of relevant information, price sensitive information, disclosure of financial results, and transfer securities. So these things, again, I'm coming back to what I've said a little, short while ago. So the focus of all this, regulation, rules, requirements are basically to make the functionaries disciplined, and to make the people who are dealing in this capital market, with their hard-earned money, aware, and to understand, the products or the company's products where they have invested are really, I mean, uh, not cheating them, and are doing good business, performing. And in case there is certain things which is going wrong and not in their hands, these are disclosed to them. There is no fraud, no cheating, and no hiding of material information. This disclosure of all relevant information having material bearing on the operation and performance. This is very important. So everything material is, exposed to the investors and to the, the fraternity of the fraternity, this investment fraternity or the investors fraternity, so that they understand exactly what is there. So it is basically, a question of transparency, and a question of being honest, question of being, providing good conduct, and the question of, feeling more responsible, and a question of giving more confidence. So this is all about this SEBI. With regard to the capital market. Now, this role of stock exchange is basically role of SEBI. I need not discuss it, elaborately, but basically this stock exchange has come with this LODR and all, which is basically corporate governance, and it is tuned with this SEBI things. Only thing we should know about this type of securities, in certain things are specified securities, there are unspecified securities, there are listed cleared securities, unlisted non-cleared securities, permitted securities. Then there is listing of securities. So you have to enter with an agreement with the stock exchanges, and they have got certain conditions which you have to fulfill, and your securities get listed. Moment it is getting listed, it comes under the umbrella of SEBI, and you have to follow the various rules, regulations, and as and when various events and activities take place, those rules and regulations have to be adhered to, with, matching with those events and activities with regard to the particular products or the particular, this kind of elements which you have thrown upon into the capital market. Again, the same thing, this equity shares, preference shares, both convertible, non-convertible, debt instruments, is bond, debentures, both convertible and non-convertible, commercial papers, units issued by mutual funds, Indian depository receipts, derivatives. Now, all these things have got separate rules and regulations established and formulated by SEBI, and basically these are, the focus is to, ensure discipline while trading in this particular items. This is important. Types of listing: this initial listing, listing for public issue, listing for rights issue, listing for bonus issue when company issues bonus share and want to list this bonus share also into the capital market. Then listing for margin amalgamation. Then there are certain important terminology used in the stock exchange. These are call option, put option, striking price, premium, maturity, excise, right, out of money. So these are, basically, I cannot do anything. These are the prevalent terms prevailing in the uh, capital market. These are, various, again, the types of securities, that is debt market, central and state government securities, treasury bills, debt securities, debt instruments, mutual funds. So these are basically debt instruments, or this mutual funds means these mutual funds which invest in debt instruments, which comes under this category. This is quite important when a public company goes for listing. These are the documents they need to, submit to the stock exchanges. This is basically memorandum articles, debentures trusted in case of debentures, copies of prospectus which have discussed, copies of offer for sale in case of, when we go for some, a private placement or something. Then copies of audited financial statement for last 5 years. Then statement showing dividend, cash, and all, cash bonuses if paid. These are for existing companies and dividend paid and all. Then certified copies of important agreements. These underwriters, and also that the investors are aware that these are the things the company has, and they can decide on their own whether the company will be a promising company or it is not that promising. A brief history of the company. Then we have got this. Shares and debenture issued in the recent past for an existing company or for an old company like this, and particulars of shares for if any. So these are basically information to the investors to know. I mean, various information about the company. So this is done. Then we are coming to. Now with all these things, this listing will be completed unless this stock exchange wants some more information or wants more clarifications or explanations. Then comes your investors awareness and protection. This is another module which I have already uh, discussed. Is investor awareness. Now, investors awareness comes from investors grievances. So these are the basic investors grievances which we have seen in this capital market scenario. These are basically furnishing inadequate information, misrepresentation in prospectus, application forms, advertisements, and other relevant documents which the investors must rightfully receive. Then there is delay or non-receipt of refund orders, allotment letters, share certificates. Then delay in listing of securities in stock exchanges. Delay or non-receipt of letter of offer in respect of rights issues. Delay or non-receipt of bonus, rights issue, dividends, etc. Delay or non-receipt of notices for meetings, annual reports, etc. So basically, these are the grievances. Now, from these grievances, these investors are wanted to become more aware how we can get rid of these deficiencies and all. So the another focus of SEBI as well as the stock exchanges and the entire gamut of the laws which have been framed in order to discipline this capital market is to see the investors do not have complaint on these grounds, and they are all satisfied investors, and they rightfully get what they rightfully deserve. This is, basically the focus. The another dimension of capital market is uh, to ensure great focus on the investors that they remain happy. So this is now the regulatory measures, and uh, I mean, apart from this SEBI, there are certain, in order to afford adequate protection to investors, if the provisions have been made in different legislation, such as the Companies Act is already there. Consumer Protection Act, sometimes the investors go to the Consumer Protection Act saying there are certain deficiencies they have faced has to be addressed under the Consumer Protection Law. Then Depositories Act, then this listing agreements and other things. So these are basically a part of SEBI's, disciplining measures to the various functionaries in the capital market. So this we have discussed, and so these are the, some kind of awareness which SEBI has thrown upon to the investors. They say that even though we are there to help you and as a father figure, but you need to have some kind of, awareness on your own. You need to some kind of self control you should have. So these are the things. Study promoters' track record and experience as well as their reputation and integrity, the background of the management team, object of the securities issue and the projected details, product technology and potential market, projected profitability and the key ratios, risk factors and pending litigations, if any, whether all required statutory clearances have been obtained by the organization, track record of the company's service to shareholders and other stakeholders. In case of existing companies, a track record of the promoters in their other group companies, if any, in case of new companies. So these are the things which SEBI wants the investors to be, from their their own standpoint, they should keep themselves aware. Now, these are the steps which SEBI has taken. This is very important. We sometimes discuss in many forums that what are the steps SEBI has taken and how much efficient these steps are with regard to solving investors, grievances, and whether all the investors are happy and all these things. So these are, this basically the stock markets have been made broad-based and well integrated. Then the system of trading has been improved and settlement period shortened. And then brokers and sub-brokers are better regulated, to offer prompt services. Greater transparency has been brought in the services of the various intermediaries. Then insider trading has been prohibited. Then registration of brokers has been tightened by prescribing norms for capital adequacy and other eligible conditions. So, these are the steps have been taken. There are other steps also. A grievance cell has been established in the stock exchanges and, of course, in the Civi, in the Civi platform for expeditious settlements of compliance of investors, complaints of investors. Information pamphlet for investors have been published with FAQs, frequently asked questions, and providing necessary information of the investor, highlighting their rights, responsibilities, and resolution of their grievances. This is quite important. Now, certain aspects of stock market and investors should know. So these are bulls and bears. I think everybody knows about this thing. I am not reading this at the moment. Now, life cycle of securities. This is also important. This is early phase, growth, maturity, and decline. In a particular security which is being dealt in the market now, in the early phase, perhaps we have seen in many cases that the returns are not, even though we've invested with a lot of expectations, but the returns are not forthcoming. So these the portfolio managers and all, and the various functionaries in the capital market, they say, you keep the money for some time more. This is an early phase. The returns will take some time to come. So this early phase is a phase where patience is required. That patience has to be there, but somebody has to be there to give confidence that it is worth that you keep patience. It generally happens in new companies. Then growth, the moment that this early phase is over, say, it depends on the nature of the product. Some product may have got 1 year or 2 years, some product may have got 2 or 3 years, some product may have got couple of months. It depends on the product and the money market and the financial market conditions, and of course the overall macro and the microeconomic conditions also. So then comes the growth phase. In this growth phase, when this the company is growing and the products are also improving and this money market condition flat out. So this in the growth phase, it has to be seen that whether the returns are coming from the security the way it is expected. The growth phase is a trend phase where the trend is established, the direction is established. When it comes to maturity, now this is a very, very important, this maturity stage. How long this maturity will stay? In certain cases, we have seen the maturity last very, very short. So maybe it's a 6 months maturity. The early phase was, say, 1 year. Growth was for, say, um, 3 years. The maturity may be 6 months or 1 year. That means the growth was quite, it's growing and people are investing and you are expecting return and returns are also coming. But the moment it reaches maturity, it will not last long. The decline will take place. So now you have to shift your investment the moment it reached maturity stage. In certain products also we have seen the growth was, say, 4 years, 5 years, and people are getting good return from the investments they have made, and the company is also generating good investments from the investments they have made. But once it reaches the maturity and when the growth has got the saturation and all, the maturity also stays for a couple of years. So you have got enough time to capitalize on the growth. This is the difference. Growth is a journey, but maturity is a point of stabilization. So this maturity, it remains, and you can safely sit on this phase that now I'm in a stable phase. But in certain cases, this maturity lasts very short. It's a very short period. So what happens if that be the case? So now you have to shift your platform. I mean, you have to shift. You have to take the investments. I mean, from the products where you already invested, you can, I mean, go to another portfolio. It is basically a change of portfolio. In the maturity stage, the decision is up to you. Will you stay in the phase, or you change your portfolio? If it is long enough, stay, reap the benefit of the maturity. If it is short, be careful and try to change your portfolio management with, with the rather discussion with your portfolio managers and all these things. You can change you can remix, review your portfolio, and change your portfolios so that you don't, hit the decline stage. So this is something very important in an investment climate with regard to a capital market, with regard to any kind of product, and with regard to any kind of, at any point in time. So the life cycle of securities: early phase, growth phase, maturity, and decline. So basic criteria when making investment, these are the things. Basic things are returns which are subject to market risk, capital growth and wealth creation. If you have got a very tendency for capital growth and wealth creation, go up to maturity stage and carefully see or monitor the maturity stage, that you don't reach the decline. And before the decline starts, you reassemble your portfolio. Then comes your opportunity for receiving bonus right shares, consistent dividend payment in case of a company, good companies, capital erosion risk, that is again decline. Before that happens, you have to withdraw. Interest payment in case of debt instruments. This is generally, debt you are compulsory unless the company goes into a problem. You can expect a problem. Interest payments and all. Then scope for diversification to minimize market risk. Sometimes what happens, a company diversifies. The moment it diversifies, it's, the product maturity also, elongates, because the moment it diversifies, new options comes, new horizon comes, the scope for earning more profits, and the more capital build up, and the more, the performance orientation, that the sentiment in the capital market, that is thrown upon the company is diversifying. The moment that happens, this maturity phase expands. So in that case, if you are in a maturity phase, your investments in the maturity phase, and the products to which, the company's products, the products for which those companies are there. So if those companies are again going for some kind of expansion, diversification, you can be almost assured that this maturity phase will keep on increasing. So you can stay with these things. But if there is no expansion or diversification after the normal maturity, say that depends, product wise, that can be understood from the fundamental and technical analysis, which I will come later on. You have to redraw, means you have to withdraw from the investment profile, and you have to reestablish or reorient your portfolio so that you again remain in your growth and your maturity trend, so that you don't lose your money which you have already earned. So this is how things are. Then scope for diversification to minimize market risk. Then the inflation impact. So that is, these are all inherent with any kind of investment. Which I was telling about fundamental and technical analysis. This is very important in a capital market, as we always, going for an investment, primary market, secondary market, products, then functionaries, then Civi, then there is a stock exchange, then there is a host of economic factors and other things, which disciplines and all, this investors and all these things. Then this fundamental and technical analysis, this is also all pervasive and very, important in the sense that, because nobody wants that the money which is invested, will go into the uh, go into the smoke, and it should definitely, give you some kind of return. There can be some temporary losses, but ultimately you should be able to, earn something, because an opportunity cost of money is there, and there is a time value of money also. Rupee one is not the same rupee after 1 year. So naturally, considering this both, this time value of money, which is both of a compounding and discounting element, and rather dimension, which is both compounding and discounting dimension, and this your sentiment that I should definitely get some return from the investment. This fundamental and technical analysis have been it has come. Fundamental analysis is this generally applies to stock or securities of companies and covers such elements as overall economic analysis, industry analysis, company analysis, and sector-specific analysis. So, for example, IND is overall economic analysis, industry analysis, pharmaceutical industry, then company analysis, Serambexi, and sector-specific analysis. That means a particular company sector. So this sector may be a manufacturing sector. So these are overall economy, the country, industry, a particular industry, and a company sector. It can be overall economic, say again India, industry, it can be telecommunication industry, company, it can be Airtel, sector, that is service industry. So these are the basic things one has to look into. It can be from micro to macro, or it can be macro to micro. Now suppose this severely, now at this point of time, this manufacturing sector is severely hit. Now if a manufacturing sector is severely hit, this sector specific analysis will always be adverse. Then the company, so any company in the manufacturing sector, say a particular industry, cement industry, so is a manufacturing sector, or oil refineries, manufacturing sector, or maybe a garment industry, manufacturing sector, automobile industry, manufacturing. So they are also correspondingly hit. So then the industry, so automobile industry, say particular company, say for example, Tata Motor. So is a automobile industry, automobile company, industry, automobile industry, sector manufacturing, overall economic India. So you can start from a specific sector analysis and reach to the overall economic analysis, or you can start with this macro functioning, that is overall economy. In now the Indian market condition is a global. This is COVID-19. These market conditions are really poor globally. There is a downhill. There's a recession. It is exactly not recession, but it's sometimes it is something. It's a lack of demand and all these things. It's a stalemate. It's a stalemate. So overall economic analysis, and then the impact of this stalemate is on the industry. Again, the impact of this industry is on the individual companies, and on the individual companies this impacts the sector also. So it can be up and down, or from down to up. So it is a both way analysis, fundamental analysis. So this also impacts how my stock is being impacted. So this is another, and next comes your uh, technical analysis. What is technical analysis? It is a trend analysis. If this is basically a statistical analysis. This relates to study of past price movements of trading instruments in order to predict their likely price movements in the future for a given period. Technical analysis largely hinges on trend analysis, which shows the direction of price movements. Establishing trend analysis and its identification in respect of a security or a group of securities is what constitutes technical analysis. Now, here, I would like to add certain things. Uh, let me say that this. It is said that invest early, invest regularly, and invest on a long-term basis so as to reap maximum benefit out of one's investment over a given period. That's okay. That's a normal axiom which we see. Now, I mean, while we deal a capital market, discussing my discussion will remain ever incomplete if I don't, discuss the the relationship, the distinction, applicability, and rather the coefficient relationship between fundamental analysis and technical analysis. This is a bit complex, but let me discuss. Otherwise, this will not look good. Now, generally, I'm speaking from the investor standpoint in the first place. Well, it's a fundamental analysis. So, I mean, the investors' fraternity, I mean, they've invested, I mean, in the capital market. I mean, irrespective of it is secondary market or primary market, we have invested in the capital market in certain products, and there are functionaries and everything. And under the umbrella of the SEBI laws, which wants to discipline, control, monitor, and help you to build confidence and some kind of this thing, comfort. So, what happens? And so this fundamental analysis, it helps you that at a given point of time, the situation of the economy, situation of the industry to which your security relates to, and of course the company and the sector. So here, what happens? You are, I mean, getting some kind of idea within a given range. This fundamental analysis don't, I mean, take you over a period of time, because at every point of time, it happens. That means every month you need to analyze the economy, you need to analyze the industry, need to analyze the company, and need to analyze the specific sector. It's every quarter. I mean, reasonably saying every quarter. So the fundamental analysis has to be rigorously every quarter. If you're very, very sensitive, every month, so that what happens, you understand, I mean, how much your stock or your investment worth vis-a-vis, I mean, the company in whose stock you have invested, because company is coefficiently related to the, I mean, to the overall economy with regard to certain parameters, and the overall economy is also related with certain coefficient, I mean, using with certain coefficient with the industry and the company as well. So these are all economy, industry, and company, and the sector are all interrelated, and their product is moving around this spectrum. So it's a constant analysis. Then technical analysis is what happens. We are analyzing the trend, the previous trend, and we are looking ahead. Is some kind of extrapolation that we do in the statistics. Extrapolation, we extrapolate whatever we have seen in the last, say, 6 months or 1 year. Based on that, we extrapolate these things over a period of, say, foreseeable future, say 1 year or 6 months or say 3 months, like this. And we see that this is, we foresee based on certain statistical information, this trend analysis. But in case of emergency, for example, this COVID-19, did anybody expect that market will clash? The all mutual funds, 99% mutual funds will be giving you capital loss. Even 1%, 2% gain is not there. Most of the, I mean, mutual funds are showing capital loss with regard to their investments. FDs are showing, I mean, FDs are all right, but other, I mean, most of the investments are showing capital loss, except those committed investments like FDs. So what is happening? But 4 5 year months back, if you have taken a trend, it's going up, or maybe, I mean, the growth may be slow, but nobody has expected that huge capital loss in all the investments will take place. Never. So this technical analysis has got certain limitations. In an economy where some abrupt situation happens, some war has taken place, or some huge natural calamity has taken place, and the industry and all these things have, some political turmoil has taken place, some coup, this military coup, and all these things have taken place. So if all these things, a civil war and all, so these things you cannot anticipate. If something has gone fundamentally wrong in the political and in the economic conditions and all these things. So what happens? So this technical analysis fails, because technical analysis is, it based on historical, I mean, inputs, and it projects, say, a foreseeable future, some kind of short-term, mid-term future. So it fails it because you have not, I mean, considered certain things which you have never apprehended, never dreamt of. So technical analysis fails when certain, you know, very, very unknown factors, untoward unknown factors comes to play and disrupts your investment, I mean, investment returns or your investment projections. So this is, I mean, the basic deficiency or the difference between a fundamentalist and technical analysis. Technical analysis, if everything, moves in a particular fashion within the expectations uh, of the government and in the expectations of the entire investment fraternity and investors fraternity rather, and as it is expected in the normal course of business, then it's fine. But if there is some abrupt interruption which has never been expected, so technical analysis fails. So this is basically one of the major thing where because nobody has expected that so many investments, so much investments of so many people will go into such waste due to this COVID-19 at the moment. But it will revive, no doubt. But again, we cannot say when it will be revived because we don't have this trend analysis data for these things. We cannot say that. So this is how this technical analysis. But in good times, normal times, I would say normal times when things moves normally, and considering normal disruptions in the economy and normal ups and downs and all, technical analysis and fundamental analysis will help you. But if there is a major disruption, sometimes happen and all, so then this analysis fails. Now comes this depository system. This is, basically we have gone into this digital system, and we have become this paperless securities, and the entire thing is done on an online basis. So this Depository Act 1966 was promulgated. So to provide for the establishment of depositories and securities with the objective of ensuring free and safe transferability of securities with speed, accuracy, and transparency by making securities of public limited companies free transferable subject to certain exceptions, dematerializing, that is paperless, securities in the depository mode, and providing for maintenance of ownership records in a book entry form. You don't have to keep this, share certificate and all these things. So this is how this depository system has come. So this is not, required at the moment, because since we are getting advanced nowadays, so this, the previous mode of keeping, paper form of securities have been replaced by this is online form where this book entry is there and it is a paperless security. So this I'm just reading out. In order to streamline both the stages of settlement process is important. The Depositories Act envisages transfer of ownership of securities electronically by book entry without making the securities move from person to person. The Act has made the securities of all public limited companies freely transferable by restricting the company's right to use discretion in effecting the transfer of securities and dispensing with the transfer deed and other procedural requirements. So this has enhanced time. This has also ensured accuracy, and this has also, given transparency and made it more, at par with the global system of dealing with securities. Depositories hold securities in dematerialized form and maintains ownership records of securities and effects transfers of ownership through book entry only. By fiction of law, a depository is the registered owner of securities held with it, with the limited purpose of effecting transfer of ownership at the behest of the owner. So he is acting on your behalf, the depository, not you. That's why the Civi has got separate rules and regulation of the depository, because the moment you're creating separate entities, whether it is legal, or personal, it is it's a legal person or a real person, some legal adherence, some kind of, adherence to law has to be there. That's why SEBI has also created some kind of rules and regulation for depositories. They have to have some kind of discipline. They have to adhere to certain kind of, you know, procedures, laws. If they don't, they will be penalized. So this is only to help the investors to ensure smooth functioning in the capital market and to ensure adequate, discipline and some kind of this what I would say efficiency in the capital market. This is also important. This is, I mean, last paragraph of this thing I did not say, but this is important. I mean, these features. This is very important because let these features be, I mean, read out so that this, summarizes the entire thing. The depository system involves conversion of securities from physical to electronic form, which I was discussing in a paperless form, settlement of trade in electronic segment, electronic transfer of ownership, and electronic custody of securities. All securities in the depositories are identical and are fungible. Fungible means these are, I mean, you can, they are, I mean, you can use some kind of securities there, so they are not amenable to corruptions or something like this. So they're fungible. Except certain specific cases, depository system is not mandatory and is left to the investor to decide whether or not to opt for dematerialization of these such securities. These are basically when you hold shares for companies which are not listed or quoted companies. Here you can have, or very closely held companies. I've seen closely held companies, companies which are not listed. So their shareholders, seldom there is any share transfer or something. They hold it. Very closely held companies. So they hold their shares in this paper form, and they don't opt for, I mean, this dematerialization. So, however, in case of listed securities, transfer disposal becomes difficult if these are not dematerialized and are not held in the depository system, because now these have become compulsory. I mean, last year they have made it compulsory. Civi has made it compulsory. So all shares of a listed company has to be listed. Otherwise, I mean, has to be dematerialized. Otherwise, you won't be able to deal with them. Then comes an investor who has dematerialized his securities can again opt for rematerialization, and the same may be carried out by the depository within 30 days of receiving such request. A depository holds security safe and what did it say? In safe custody, just like a bank holding custody of cash, and the printer process has an inbuilt secure environment to ensure that this is completely safe at all times in the depository system. Any transaction in the securities can only happen on the official request of the actual owner or beneficial owner when there is a beneficial owner is there. Maintenance of records of all clients both by the DP and the depository, and daily reconciliation of balances. So that there is a daily reconciliation of balances. We generally get statement also from the depository that what is the opening balance and closing balance, and so that the investors, I mean the particular holder, I mean the shareholder, the stakeholder is aware of the movement of the shares. Some kind of record he also gets from the depository. Issue of fortnightly statement of holdings to the investors and beneficial owners, which I have just now told you. Comprehensive insurance policy for all depository account holders. So this is also important. There are two, I mean, depository systems in our country. This is National Security Depository Limited (NSDL) and the Central Depository Services Limited (CDSL) are the two depositories providing depository services in the electronic form from securities traded in equity and debt market. Then there is a role of custodians in the depository system. A custodian is basically an organization which helps to register and safeguard the securities of its client. Fundamentally, fundamentally, this is this function. Besides safeguarding the securities, a custodian also keeps track of various corporate actions in respect of the securities on behalf of its clients. He also sometime inform the client about the various say some kind of information about the organization is coming with some kind of rights issue or public issue or something like this. Then this SEBI depository participants regulation, that is only to, I mean, regulate these things which I have discussed, that each and every entity is a legal person or a physical person is controlled and monitored by certain kind of regulations by SEBI. Then comes your venture capital. Venture capital I will discuss a little. I mean, Then we have got, Civi venture capital funds regulation. That is also there. If these venture capitalists want to, come to India and play in the capital market, they are also required to adhere to Civi venture capital funds regulation 1996. And there are so many other things about venture capital and when they invest in certain things. Now let us discuss about venture capital. So these regulations I'm not discussing because these are, inbuilt in the SEBI laws, SEBI regulations, SEBI rules. I have got nothing more to say because I am not the architect of these things. I can only explain about the conceptual framework about your venture capital, which I am. Let me read this thing and I will explain while I read. Venture capital is the capital that is invested in equity or debt securities. Just see, it is equity and debts and debt securities. So this is again listed. I mean, if this equity and debt securities are listed, so they are coming under the fold of listed securities and coming under the fold of SEBI, and automatically the venture capital gets attracted and comes under the umbrella of SEBI. So naturally, I mean, venture capital has to adhere to and conform to the SEBI regulation. That is why SEBI regulations have been promulgated, because venture capitalists now, if a venture capital invest in a unlisted company share or debt capital or in some private ownership. So these SEBI regulations may not be required, but sometimes venture capital comes to companies or organization. They're already listed or they want to get listed at later date. So naturally, they have to conform to the SEBI regulations because now they also get interconnected by this relationship of I mean, a coefficient relationship, because when I am related to you, you are related to somebody, he is related to somebody again. So there is a relationship coefficient through which it gets related to the SEBI framework. So now this is debt securities with equity conversion norms of young, unseasoned companies promoted by technocrats who attempt to break new paths. It's a source of finance for new or relatively new, high risk, high profit potential products as the project belong to untried segments with new or advanced technologies. Since it is difficult for the promoters to arrange finance for such projects through conventional sources, the venture capitalist steps in to fill this gap. The venture capitalists are smart investors who come forward to face high risk with a calculated belief of making much bigger gains when the new project succeeds. The success of a venture capital funded project depends on the care with which the project is evaluated and selected for investments and the trust reposed by the venture capitalist in the capitalist in the capabilities of the promoters. Normally, and this is important, venture capitalists take faster decision in appraising project and releasing funds than banks and financial institutions. After the project becomes viable and starts earning profit, venture capitalists sell their equities at a much higher prices, which justify the risk taken earlier. The objective of venture capital investment is to earn capital appreciation in an innovative project over a relatively shorter period of time. So basically, I mean, these venture capitals are, I mean, are there when in particular projects or companies, or when some entities, when it's a new company or innovative something, some kind of project which has not been tried earlier, and these banks and financial institutions are a bit reluctant to help them, but it has got tremendous potential. The business plan must be very, very, attractive and all, but still, since it is an uncharted area, the normal, this customary bank finance is unavailable or is not available. I mean, in adequate quantity or something like this, in adequate quantum. So in these cases, this venture capitalist, they are generally guided by some kind of emotion. They are emotionally inclined. They're passionate about new ventures and they want to do something with passion or something, and they are emotionally inclined. At the same time, they also expect a good amount of return. So venture capitalist, from the standpoint of an investment, has got a two dimension. One is they are emotionally inclined, they're passionate, and they are also commercially inclined. That means they also want the return. When this emotion and commercial dimension, I mean, are there. I mean, so these venture capitalists are there. Because in a bank and financial institution, there is no emotion. They will look into, I'm giving you 1 rupee, whether this 1 rupee will be protected and I should be able to get back. Since you're a new company and you don't have that kind of, this backup or the background or some kind of this management expertise at this point of time, and you have not tried that path earlier, I'm not very confident. My entire finance may fail. Your unit may fail. In that case, I may not be able to recover or get back my money which I'm giving you. In this particular case, venture capitalists, they are also governed by emotions. They say, no, I have got an emotion, I'm passionate about it, I will go. And I'm also confident about that return, which may be coming a bit late or maybe fast also. But I am more concerned with my emotion and passion, not of the return, but return will automatically come. So it is secondary. First is the emotion. So there this venture capital comes. But since they're also investing in listed securities, SEBI comes, and SEBI also controls and see and monitor that they are not doing anything fraud or anything mischievous, or they have committed certain things which they have not done, or they are not putting any extra pressure on the organizations or something like this, so they are not demanding something which is unreasonable. So when they are in the capital market and investing in the products in the capital market of a particular country, say India, they are also following certain norms and rules. So this is the thing. And so this venture capital stays with the organization in the initial see that from the early stage, they take that growth stage, which I have explained it earlier. They take the growth stage, and the company is slowly going up, earning profit, and they are actually absorbing the fixed cost and all these things. And the journey is happy, and the investor and the venture capital investors and other investors, if any, they're also earning good returns, and the company is going towards maturity. The moment it attains maturity, then the venture capital, in the most of the cases, they say enough is enough. We have helped you. We were emotional and passionate about the new things. We have guided you. We have invested our funds. We have got our returns. Now we would like to. Sometimes the venture capital stays also even in the matured stage. They want to reap the benefits on a long-term basis. Sometimes they say, "Take, let us, take our funds out of the company. Now you are self-help. You can, take care of your own self, and let us put our funds into some other companies which are again new and also need our support, and maybe they're unable to procure sufficient fund from the normal or the regular banking channels. So these venture capitalists are like nomads, they always travel from one place to another. As nomads, they travel from one posture to another posture, so one green posture to another green pastures. So venture capitalists, to some extent, nomads. So they are with this company today, say another company tomorrow, another company tomorrow, but helping them in growing up due to their emotional inclination towards the project. At the same time, they are also expecting the returns to come in most of the cases, unless there is some abrupt disruptions and all these things. They generally get their returns to the extent, they have expected to, sufficiently cover the opportunity cost of the investment which they have done. I mean, at the beginning of the project startup, at the beginning of the startup of the project. So this is the basically role of the projects. They are nomads and they are guided by emotions and of course of the commercial instinct. But they stay till the company grows and give them the return. So this is something we have discussed this about this venture capital. It's very interesting, and we can have a lot of discussion on venture capital. But since capital market is the main focus, we leave this venture capital over here. Now, this mutual funds, a broad category of mutual funds open in the capital market are here. This we should, of course, state. This income funds or income-oriented scheme, then growth-oriented schemes, then hybrid scheme, which we have discussed, is a balance fund. The scheme focus on generation of both fixed income and growth, high growth scheme. Then there are also then there are short-term liquid funds, which is money market mutual funds. Then there are these are basically commercial papers, government treasury bills. Then tax saving schemes, mutual fund like ELSS. Then there are special schemes. These are index schemes, sectoral fund schemes, real estate funds, etc. Offshore funds. Offshore funds are funds which are, abroad, and all these hedge funds. Hedge funds are deployed for speculative trading. Then open-ended funds, these funds are with non-fixed number of outstanding shares units that stands ready at any time for redemption on demand, and the transaction take place at the net asset value is calculated on a periodical basis. So now, generally, senior citizens and people who are very, very, sensitive, and they want the fund at any point of time. I mean, they are not. I mean, they need money actually. They cannot risk the time horizon. So open-ended funds are for them. They can, at any point of time, they can redeem their investment and get the money back based on the NAV prevailing at that point of time. And this NAV is there, and the definition can be read from this. Then close-ended funds, it's a time where the mutual fund manager sells a limited number of shares and does not stand ready to redeem them. That means these are generally, say, for 5 years. So this is a lock-in period. Is there? Say mutual fund have invested, so it is a 3 years or 5 years. So within that period, you cannot redeem this thing. But these close-ended funds, they generally give, better interest, better return than the open-ended fund, because open-ended funds have the risk of any moment the money can be taken out. But close-ended funds, this managers or the portfolio managers managing the fund assured that the funds will remain closed till such and such date, and there would not be any withdrawal. So I can invest these funds on a reasonable time horizon and all these things. So I can earn a lot and share a lot also. That's why the closed-end funds have a better payout than the open-ended funds. This is the difference. And general comments on the mutual funds. These are, it is not very long. We can discuss these things a little. This is general comments. These are bottom-up investing. This is an investment strategy which considers the fundamental factors driving a company's stock performance before considering the economic prospect which affect the industry to which the company pertains. Good. This is one. Top-down investing. This is an investment strategy which takes a view on the economy and then looks at the industry scenario to assess the potential performance. That which I've discussed, that technical analysis and fundamental analysis. So one is going from macro to micro, other goes from micro to macro. Then equity funds are considered aggressive insofar as higher capitalization is sought and is ideal for investors having a long-term orientation, because equity funds are subject to market fluctuations. So that's why this is, you have to, equity fund investment have to be hold for a long term. This is the thing. Then balance funds, these are considered moderate for investors seeking growth and stability. And moderate, they're actually a mix of debt and equity. The exact balance of the two assets classed under this investment scheme depends on the fund manager's ability to take risk and his priority for the expected return. Balance funds are both, equity is a mix of equity and debt instruments. Equity fund, only equity. Income funds are regarded as conservative, and these are suitable for investors who expect regular fixed income from the investment. Money market funds are regarded as highly liquidity oriented and suitable for investors who look for safety and liquidity. Tax saving fund schemes, these are benefit. If you invest in these funds, you will get Section 88 income tax benefits. Closed-ended scheme, we have discussed that for a given period of time, you cannot redeem the investments. So these are basically types of schemes available in the market. Open-ended scheme, which are at any point of time. So this again, this whole host of schemes are available again based on which I have discussed a little earlier. This investors' preferences, the market dynamics, and the legal laws and all these things. Now, if in a particular scheme you find there's a tremendous complexity of law and all these things, so we may not be able to. The investors are not very much interested, so that schemes dies out. So investors' preference, the legal, rules and regulations which governs the scheme, and the market dynamics. So this basically influences or impacts the types of scheme that will be available in a capital market at any given point of time. What are the this advantage of a mutual fund? This is very important. This is professionally managed, diversification in the investment portfolio because they have got a wide spectrum of equity or equity and debt or only debt, whatever it is. Then convenient administration because they have got expert people, these portfolio managers and this mutual fund managers are there. They manages this investment and they always doing this technical analysis, fundamental analysis, and they keep track of the company's if performance, and also that they are always on this job. Then this convenient administration, this is then return potential high if the investment is kept over a medium to long term. That's definitely uh, one of the rules of investment, that you have to keep it over for a pretty long time. Low cost, yes, low cost, because the risk is distributed over a wide spectrum of elements. That's why the risk is the return of potential is high and this cost is low. And it has got liquidity, provided it is not a closed-ended scheme. And it has got transparency. They also send you a lot of documents and all these things. So that one can understand that how the investment, the direction of the investments in a particular um, portfolio and in a particular security or in a particular fund, how the direction is going and how it is performing. And there are scopes also, redistribution. You can withdraw from a particular scheme and go into another scheme if you find that scheme is not doing well. So this transparency gives you an option to do that, and the managers of the mutual fund or the portfolio manager managing the particular mutual fund will help you getting done these things. Now, judging every mutual fund, following factors will look into. Now, based on those things, now it is, yeah, it is the investor's perspective how you can judge whether the fund is stable, whether it is a liquid, if the fund is liquid and it is listed, whether it offers increase in NAV and consistent growth in dividend, capital appreciation, etc. Sometimes a mutual fund don't give dividend, so capital appreciation is there. If it is dividend, it is giving dividend continuously, and the dividend is growing because it's a time value of money. So naturally, dividend growth is also there. Then comes whether the investment objectives are clearly laid down, whether the issuer has a proven track record and offers assured returns or return close to the assured return, whether it observes investment norms to balance risks and profits and returns, whether various statutory compliances as applicable are consistently met. So this is a general common sense. Any investor will have this kind of questions to be answered to the mutual fund, and will get it answer that whether the investment in the mutual fund is sufficiently comfortable. Now, this risk involved, this is sometimes risk involved mutual fund investment, excessive diversification of portfolio, thus losing focus on the securities of each segments. So, since this mutual fund diversify extremely, debt, equity, there may be 100 equities they've invested, there may be 50 debts they have invested, they've spread about the risk. But too much diversification is also risky because you lose track. This is they wanted to say. And too much concentration on blue chip securities, which are high priced and do not offer more than average. There is another thing. Poor planning of investment portfolios because you have expanded, scattered too much. So that poor planning comes, that is from extreme spread over. So you need to control the spread. And unresearched forecast on income, profits, and government policies. So the research, your analysis, the fundamental or technical analysis may go wrong. So that again give you some kind of wrong guidance. Inexperienced fund managers and non-accountability for poor returns. And this failure to identify the risk of the scheme as distinct from the risk of the market. So this is another thing. So these are very, risk of the market and the risk of the scheme. Inexperienced fund manager, non-accountability, because this fund manager are not accountable to the investor. You have invested according to your own choice. But the problem is, this your inexperience will cost the investor. That they wanted to say. Now, mutual fund cost, these costs are operating expenses and these sales charges. Sales charges are front end load, and back end load. So this is enough. Then there are some asset management companies. These are this another class of companies. This is there. this under the Civi regulation, every mutual fund is required to have an asset management company they manage to manage the funds of the mutual fund. For example, when we issue debentures, there is a debenture trustee. They manage the debenture and all these things. That debenture trust is created. So when there is an asset management company, they manage the this mutual fund. So particular mutual funds. For example, this Axis Bank has got a couple of mutual fund, and so they have got this asset management company who manage this a mutual fund for them. And so this AMC should be approved by the SEBI again and enter into an agreement with the trustee of the mutual fund to formulate schemes, raise money against units, invest the funds, and after meeting the permissible costs, distribute income to the shareholders of the funds. So they are basically, I mean, some kind of, they manage this asset management company, the this mutual fund. So this is basically SEBI is keeping some kind of layers. These are investors. There are mutual funds. Mutual funds have got some kind of trustees, the managers and the portfolio managers. And again, they are managed by some asset management company. So, I mean, things are very, very, they hierarchically layered. So, if sometimes somebody take a wrong decision, if something goes wrong, you can fall back upon another cushion so that the entire spectrum of making the entire system disciplined and ensuring control remains. So these are the basically, control mechanisms which SEBI has established so that things run smoothly, at the same time things goes well. Then there are certain investment valuation norms for traded securities, and then there are investment valuation norms for non-traded securities. So this is how these traded securities are being done, and this is and some non-traded securities. So this is in the PPT itself, should not be a problem. And then this is portfolio managers, which I have already discussed, and a portfolio manager is in the capital and securities market. A portfolio manager is a professional with experience and expertise in the field of evaluation of various investment schemes so as to project the best return for an investor with a reasonable safety from a given set of investment under a given market conditions and over a given time frame. So a portfolio manager is a professional who guides the investors, I mean, from the point of getting their expectations fulfilled and to ensure safety, so that the investment, I mean, the investors are, I mean, satisfied. At the same time, they feel, I mean, confidence because they are not experts, so they know that there is somebody to guide me. This portfolio managers is a person who, pursuant a contract or arrangement with the client, advises or directs or undertakes on behalf of the client client, the management or is administration of a portfolio of securities. Discretionary portfolio manager is defined as one who exercises or may exercise under a contract relating to portfolio uh, management any degree of discretion as to the investment or the management of the portfolio of the securities of the client. So one is discretionary when, I mean, he's requested, he does, and another, he is continuously helping you. He is basically some kind of, friend, philosopher, guide with regard to your investment, and is guiding you that your investment is safe and you are protected. So now there are certain laws, as usual, by the SEBI to protect and to, I mean, discipline the portfolio managers so that they also they have to adhere to those things, and they cannot, I mean, take their own decision on certain things. They have to adhere to the SEBI rules. Then this merchant banking and merchant bankers in the capital securities market is another important thing. So the role of merchant bankers. So they are how this merchant bankers, the role of merchant bankers, they manage public issues of securities, undertaking underwriting obligations connected with a public issue, managing advising on international offering of debt and equity, private placement of securities, primary or indirect relationship of government securities, corporate advisory services related to securities market, covering such areas as takeovers, acquisitions, disinvestment, etc., stockbroking, advisory services for projects, syndication of rupee term loans, international financial advisory services. They also have a host of activities with regard to the investments. It is basically managing, advising, and also functional to some extent, because they need to be functional also, because they interact, and they also indicates a lot of pros and cons in the process, so that the investors, can take some course of action which will not put them into difficulty or trouble in the at a later date. So in essence, this is the crux of the thing we have discussed. A merchant banker is an entity or a person engaged in the business of issue management by making arrangements regarding, this is a functional function, making arrangement regarding selling, buying or subscribing to securities, or acting as manager, consultant, advisor, or rendering corporate advisory services in relation to issue management. So they are basically functional as well as advisory. So this is how they are also very, their role is also very important, these merchant bankers, just like your portfolio managers and others. They are also very important. These merchant bankers are also guided by a number of new rules and regulations, so that they also, we want them also remain disciplined and act as per the rules and regulations, so that the investors also remain confident that they are also one of the other figures guiding them honestly, in good spirit, and with confidence, and they are not going to lose money, and their investors are safe. Basically, if I want to, tell you in nutshell, the role of all this function is, the role of, the trusteeship. SEBI has ensured that these functionaries are in a position of trust. That is some kind of utmost good faith. The moment I invest, then utmost good faith is created in the capital market. But capital market is a legal entity, so I cannot go and ask them anything which I need to know. So these functionaries are there who are driving this capital market, apart from the economic conditions, of course, and they are in the position of trustee. So they are in trust for me, for the investors, that your investments are in safe hands and it is going in the right direction. We are advising you, and that it is going the right direction, and you are confident, and you're protected to get the right return, unless there is some very very disruptive things which one cannot comprehend, something like that. That is, beyond one's control. That is some god, something which we call these hands of God, something like this. But they try to, they are also not God, but they try to ensure that your investment remain in safe hands, and they act as some kind of trustee to the investors, the fraternity of investors. And for this, all these rules, regulations, and everything is there. Now comes the, I think we have reached the last stage, this corporate governance, and this is the principle and practice of corporate governance in the capital and this securities market. So, principle and practice of corporate governance in the capital and securities market is directed towards ensuring building environment of transparency, accountability, and trust, which I was emphasizing again and again. This accountability, trust, and transparency amongst the various stakeholders, so as to foster integrity, efficient business conduct, and compliance with the prescribed legal provisions as applicable. Further, the spirit of corporate governance, if followed and practiced in the various facets of capital and securities market consistently, will ensure investors confidence manifold and help improve legal, regulatory, and institutional framework of the securities market and all stakeholders involved in the process. Following elements are essential. These are the corporate governance framework should be developed with a view to impart transparency and functional efficiency of various intermediaries who facilitate securities market operations. That means performance. Even though there is corporate governance, it is not simply tick box. I'm ticking this, like this. It has to be performance oriented. The legal and regulatory requirements should be consistent, transparent, and reasonable. The responsibilities, obligations of different authorities related to the functions of stock market should be clearly expressed to serve public interest. Stock market regulation should support the spirit of corporate governance. Basic investors' rights should be protected with utmost care. This is very, very important. Investors should be sufficiently informed about all material facts relating to their investments, and adequate opportunities should be available to them for expressing their grievances and proper resolution of the same. Institutional investors should disclose all pertinent material information with regard to their investments, including their voting rights. Insiders trading and market manipulation should be prohibited and monitored carefully by developing appropriate vigil mechanism. Corporates whose shares and securities are listed should provide to the investors all material information on time and ensuring the information provided are true, fair, and accurate. The rules and procedures governing the acquisition of corporate control in the capital market and essential elements of transaction, the merger, amalgamation, etc., should be clearly disclosed so that the investors understand their rights and possible recourse. This is one. And another thing is your various financial markets intermediaries and all these things must also subscribe the various functionaries rather also subscribe to the ethos and spirit of corporate governance as applicable to them, so that the sum total of their conjoint acceptance and following of corporate governance, rather adherence of governance practices, will promote the overall well-being, overall overall governance framework and effectiveness of the nation's securities and capital markets. That means the overall well-being of the capital market can be achieved if this corporate governance can be followed by each and every functionary in the capital market in its true spirit. That is what is actually meant over here. And this also, I'm not reading this paragraph, but this also now this risk management, this what happens in a capital market, there is a lot of risks and all these things. So if there is a proper capital corporate governance is in place, it can also identify the various risk factors, the probable risk factors, and can ensure that this can be mitigated and can make the investors aware that these are the risks which are probable in this kind of investments, as it is your decision to remain in that particular scheme or to come back, come away from the scheme. So for example, since securities market deal in multiple or other multitude of financial products which are but investments of both common people, most retail investors and big corporates as well in a complex market scenario, where many variable factors influence market behavior and its results are dynamic, impacts favorably or adversely the value of the investments over time. A great onus lies on the operators in the securities market, these functionaries, to ensure that the investment remains safe and grow healthy to create value and welfare or the wealth for the investors. Keeping this objectives fundamentally, it indeed becomes extremely pertinent on the part of those operators to identify the probable risk factors that may undermine the objective of any investment over a given period of time. This triggers the function of managing risk associated with any investment in a dynamic and unpredictable market. Here, the role of corporate governance is very, very pertinent. So this which I have shared in my PPT, that the adoption of corporate governance practice by various market operators, which I was explaining now, make in the market, market operators or marketplace in the securities market is expected to mitigate the impact of such risks on investments by guiding the investors to make necessary changes in their portfolio of investment or even withdraw from certain scheme well in time. So this is the basic thing. I'm guiding you, and if I am following corporate governance, so everything is in place: transparency, accuracy, with the performance criteria, and the role of trusteeship. So I am also, respecting my role. I'm adhering to my role. I'm helping the investors with a lot of confidence that they are also, in proper place, in proper shape. Their investments are also in good shape, and they don't have to worry and be anxious much with their investments. But seldom in real world it happens to that extent of 100%. But anyway, these are criterias which help them to be like this. Then comes this insider trading. Insider trading is, it signifies some unethical practice of trading in securities on the stock exchange to one's advantage by having access to certain confidential information. Suppose the employees of a company or the people who are in the higher ups, they are, aware of certain price sensitive information. The prices of certain stock will go up, some rights issue or bonus issue is coming, and they start, buying or they inform certain, their colleagues and some closed circuit and the promoters and all. So they keep on buying at the, but the other, the general public, the general investors are not aware. So they take the price advantage, and naturally when the issue is declared, they find that yes, everything, we are having make a lot of gain. So, and now sometimes the prices fall, there's some closure or some, something is some mergers or something is taking place in the company, or some promoters or some major dissociation is taking place or something like this, and the share price will go down. So and this price sensitive. So top management has come to know, and then they're aware of this thing. So they start selling those shares at the higher rate at which they have bought, so that when the price comes down, they have already taken the benefit of it. So they are not losing money when the price falls down, and when the price goes up, so they have made profit. So this is what insider trading. They know the information when the price will come down and when the price will go up, and they trade accordingly, taking the advantage of the price movement. While the normal investors, they're not aware of it. They are exposed to the risk of such price movement. That's why they're saying that insider trading is not allowed. So in some, it is one of the corporate governance. So when the the directors, they follow this corporate governance and let's say, so there's some kind of undertaking they have to give, that we will, even though we come to know about this insider information, we will never share such information, or we never act on this information. Let it be as it is, we are not aware of any information. So this is called insider trading. So it signifies an unethical practice of trading in securities on the stock exchange to one's advantage by having access to certain confidential information. For instance, when the key employees of a company who have access to company strategic information use that information for trading in the company's share securities to their own advantage on the stock exchange, it is called insider trading. The practice is highly discouraged by, you know, uh, SEBI, as it delimits the practice of fair trading in capital markets, causing sufferings for the common investors. Corporate governance principles and practice strongly discourage insider trading, as this exploits the investment climate in the capital market and give undue advantage to certain investors at the cost of other common investors who stand exploited by such practices. So this is, this I have beautifully articulated that what is insider trading. So this actually completes my discussion about this insider trading and all, and this corporate governance. So let me conclude by it is um, saying this. So this particular capital market discussion of the delivery has been based on certain important modules. These are very structured modules, of course, and we can have more discussions, but I've made it summarized structure, so to cover it within 2 hours time. And the basic facets of capital market has been discussed, and the basic market, this primary and secondary market, we have discussed. The functionaries, this merchant bankers, this portfolio managers, we have discussed. We have discussed the, the controlling authorities, basically SEBI and stock exchange, that also we have discussed. We have discussed other functionaries, basically these merchant bankers and this the asset management companies, the mutual funds and custodians and the depositories we have discussed. They're also part, they're all players, they're all team in the capital market. When the capital market is active, these players are there. Everybody's playing their own role. The investors, they invest the money, and these players, they are individually, collectively, in an aggregate, play a certain kind of function, which in a sum total way, in a wholesome way, gives the dynamics of capital market. Merchant bankers, they play certain role. This depositories, they play certain role. The portfolio managers play certain role. Civi is guiding, controlling, monitoring, penalizing for any non-adherence to laws and regulations, and indiscipline, of course. And the markets are already there. The market is a platform. The products are there. These products emanates from the customer's preference, and investor preference, the laws and the market dynamics. These products are flowing. It's just like water; it flows. Some kind of is a flowing entities, and this needs to be controlled, documented, and it has got a financial tag attached to it. And this analysis, this technical and this fundamental, moves across, over a period of time, and considering the overall economic condition, both macro and micro, the industry parameters, the nature of, the company, the sectors, and see that whether any, course correction is possible to give the investors their rightful return. And so this way, this gives us some kind of wholesome exercise in the capital. It's a very dynamic, very interesting, and it may take another couple of hours to discuss so many things, because the fundamental and the financial analysis or technical and financial analysis itself may take another 4 5 hours if I go deep into it and how it works out. The statistically, the role of a portfolio manager, the portfolio wise, this their discussion, their advices, the role of a merchant banker, company specific, product specific, industry specific. These things are the asset management company, their role with regard to the mutual funds and other things. So these are, and the criteria of individual products, and this thing, how a particular product, for example, a particular share, equity share, may behave in a different way at a different point of time for a different company under a different industry. So this has got a time dimension and the functional dimension also. And so many products in a capital market has got so much of cross relationships. When the debt market goes down, it has got some kind of impact in the equity market. When equity market goes down, some impact falls on debt market also. Even though it may not be that way, but some kind of that coefficient relationship is there. So that also impacts. So this way, it is a very very you know interrelated market where nobody can create some kind, kind of what I would say, 100%, cannot give any kind of 100% guarantee that in respect to the movement of the share prices or the prices of any security, that the security prices, it is impossible to give a 100% prediction of the thing, because there are numerous variable factors which move in its own unique way, in a cross-functional way. Sometimes it is impacted, sometimes it has got a cross-functional impact, which is very very difficult to articulate and comprehend also. So and time is of course a factor that has got, some kind of influence on them. And now after this, this overseas, this global impact and all, the overseas market also impacts. Some kind of the petroleum prices have gone high in the Middle East. That will impact the money market, the financial market, and the capital market in a country, because we import oil. So these things are there because this has got a relationship with the international trade also. Each and every company is in a some kind of global business and all these things, and the economy is in a global business. So it is a global elements and the global information, the global factors which impacts this entire money market, financial market, and the capital market also, at a very very macro level, which slowly propagates into the particular economy's money market, capital market, and the industry's money market, industry related securities, or rather, I would say the specific segment of the capital market where this industry is, and the securities, I mean, to which that industry and the company pertains to. So this is a very, very dynamic situation and a dynamic atmosphere, and we have given a broad idea how the entire thing functions and operates. But 100% prediction of the movement in a capital market is impossible, and it is beyond one's comprehension. So let us be satisfied whatever we have discussed today. I mean, till now it is, and let us conclude this, and we will come back if an opportunity is, is given to me afterwards, or in some time afterwards, on this topic once again. So thank you, everybody. Thanks a lot.